Hello everyone, welcome back to Swadhyay. In previous videos, we have revised basics and residential status and we have come to heads of income. In heads of income, we have revised income from house property. Today, let us revise income from the head salaries. So, first, let us see how income from salaries is computed. Computation of income under the head salaries under the optional tax regime. While computing the income from salaries, there are few components which are to be added and there are few deductions which we reduce from the salary amount to arrive at net salary. So what are these components? The first one is basic salary. The second one, fees or commission. The third one is bonus. The fourth one is allowances. The fifth component is taxable perquisites or any other perquisites. Then comes the retirement benefits. These retirement benefits are subject to exemption to some extent. After providing such exemption, we will add the gross amount to the salary while computing the income from the income under the head salaries. After adding all these components, we arrive at gross salary, from which we provide for deductions under section 16. They are standard deduction, entertainment allowance and professional tax or tax on employment. After reducing these deductions from gross salary, we arrive at net income under the head salaries. So, let us discuss each component one by one. First, we know that for every head of income, there is one section which is charging section. For the income from the head salaries, the charging section is section 15. There are few points which we have to know regarding the salaries. The first point is salary is chargeable either on due basis or paid basis, whichever is earlier. That means either on accrual of salary or when the payment is made, whichever is earlier, such salary will be chargeable to tax. When the salary is paid in advance, the payment has been made in advance. It is assessed in the year of payment itself. But if the salary is paid in arrears, that means the salary is accrued in previous year, in 1 year, and in the later year it is paid. In such a case, if the salary amount which has been paid in arrears is already assessed previously on due basis, it cannot be taxed again when the actual payment is made. One more important point is, for the income to be considered as salary, there should exist an employer and employee relationship between payer and payee. The job might be full-time job or part-time employment, it doesn't matter. And the payment made by the employer can be in monetary terms or non-monetary terms. But there should exist a relationship between of employer and employee between the payer of salary and payee. If there are more than one employer, there may be cases where the employee is working under more than one employer. In such a case, we will club all the salary amounts from all the employers under this head. The next concept is foregone salary. Once accrued, subsequent waiver of salary does not absolve a person from liability to income tax, which means once the salary has been accrued, subsequently if the assessee or the employee claims waives of such salary, it does not absolve the assessee from the liability to pay income tax. But in case the assessee or employee surrenders his salary to the central government, such salary amount which has been surrendered will be exempt. So heading to the first component in computation of salary, that is basic salary. What constitutes the term salary? It is given under section 17 that salary includes wages, any annuity or pension, any gratuity, fees, commission, perquisites, profits in lieu of or in addition to any salary or wages, any advance salary paid, or leave salary or leave encashment, provident fund, central government or employer contribution to pension scheme to the account of employee referred to in section 80 CCD, and the contribution made by the central government in previous year to the Agnivir corpus fund account of an individual enrolled in the Agnipath scheme referred to in section 80 CCH. So all these constitute under the term basic salary as per the definition given under the section 70. The next component is fee or commission. If the employee works for additional hours, the additional payment made by the employer to such employee is fee or commission, and it might be a fixed amount per month, or it can be given as a percentage of sales or turnover. Such amount will be fully taxable. So fee or commission means the additional payment made for the extra work done by the employee. It is fully taxable. It might be a fixed amount per month, or it is given as a percentage of sales or turnover. The third component, bonus. Bonus is a part of profits of the employer. Any profits earned by the employer, if he distributes it among the employees in the form of bonus, it is fully taxable. The fourth component, allowances. Allowances are monetary payments made by the employer to the employee to meet specific expenditure, whether personal or for the performance of duties. When the employee incurs any specific expenditure, either for his personal reasons or for the performance of his official duties, if such expenditure is met by monetary payment made by the employer to the employee, it is called allowance. Allowances are categorized into four types. Allowances which are fully taxable under the both regimes, that is optional tax regime and default tax regime. Allowances which are fully exempt under optional tax regime only. Then comes allowances which are fully exempt under both the regimes. Then comes allowances which are partly exempt under the optional regime and fully taxable under the default regime. First, let us discuss allowances which are fully taxable under both the regimes. I have given a code DTC, few points to remember these allowances which are fully taxable under the both regimes. So let us discuss them one by one. DTC. D stands for DNS allowance, T for transport allowance, and C for city compensatory allowance. DNS allowance is provided to the employee to meet the inflation, that is the increase in prices or inflation which is occurring day by day. To compensate the employee, the employer gives DNS allowance. The transport allowance, it is granted to meet the expenditure for the purpose of commuting between the employee's residence and the place of his duty, that is his office. The transport allowance given to the employee who is other than a blind, deaf, dumb or orthopedically handicapped employee will be fully taxable. City compensatory allowance. City compensatory allowance is compensation to the employees for higher cost of living in the cities. So DTC stands for DNS allowance, transport allowance and city compensatory allowance. These are fully taxable. Then comes FEW, FEW, fixed medical allowance, entertainment allowance and warden allowance. Fixed medical allowance is paid to meet employees' medical needs. Entertainment allowance is paid to meet the expenses towards the hospitality in receiving the customers. Such expense will be incurred by the employee and the employer will pay for such expense. Warden allowance. An allowance to an employee working as a warden, that is keeper in an educational institution. So FEW, fixed medical allowance, entertainment allowance and warden allowance are fully taxable under both regimes. Then comes points POINTS. Project allowance, overtime allowance, interim allowance, non-practicing allowance, tiffin, lunch or dinner allowance and servant allowance. Project allowance is paid to meet any project expenses. The overtime allowance is paid to employee who works overtime, that is beyond the normal official working hours. Interim allowance is paid to the employee by the employer instead of the final allowance. In the meantime, it is paid. Non-practicing allowance. A financial compensation paid by the government or other entities to the medical professionals who cannot practice due to certain circumstances. It is non-practicing allowance. Tiffin, lunch or dinner allowance is provided to employees to cover the cost of meals or snacks they consume during the working hours. Servant allowance is paid by employer to the employee so that he can engage any servant for any services. Any other cash allowance will paid by employee to the employee will also be fully taxable. So, what are fully taxable allowances? DTC, DNS allowance, transport allowance and city compensatory allowance. Few, FEW, fixed medical allowance, entertainment allowance, warden allowance. Then comes points, project allowance, overtime allowance, interim allowance, non-practicing allowance, tiffin, lunch or dinner allowance and servant allowance. Coming to the next type of allowances, which are fully exempt under optional scheme only, optional tax regime only. Allowances paid to Supreme Court or High Court judges, allowances from United Nations Organization and sumptuary allowance. These are fully exempt under optional tax regime, that is as per the normal income tax provisions. And also it is provided under their respective acts which other than income tax act, under the respective acts it is provided that these allowances are fully exempt, but it is not mentioned if these are allowed as exemption under a default tax regime. For now, these three allowances are fully exempt under optional tax regime, and also these are fully exempt as per their respective laws. What are they? Allowance to Supreme Court or High Court judge, allowance from UNO and sumptuary allowance. Then comes the one and only allowance which is fully exempt under both the tax regimes. That is allowances which are payable outside India. These are fully exempt under both the schemes. The fourth category of allowances, which are partly exempt under optional tax regime but are fully taxable under default tax regime. The first one is house rent allowance. It is fully taxable under default tax regime and it is exempt to some extent under optional tax regime. What is HRA? House rent allowance is special allowance specifically granted to an employee by his employer towards the payment of rent for the residence of employee. It is exempt to the following extent. The least of the 3 points given here will be the exempt amount. First, what we do is in computation of salary income, we will add the house rent allowance which has been given to the employee to the salary. In computation of salary, we will add such amount. Then, if the assessee opts for optional tax regime, we will reduce the least of the following 3 amounts as exemption. So, what could be the exempt amount? Least of actual HRA received, rent paid minus 10% of salary, or 50% of salary if accommodation is located in Mumbai, Kolkata, Delhi or Chennai, or 40% of salary if the accommodation is located in any other city. HRA actually received or rent paid minus 10% of salary. The amount we arrive by reducing 10% of salary from the rent paid amount. Then 50% of salary if accommodation is located in Mumbai, Kolkata, Delhi or Chennai, or 40% of salary if the accommodation is located in any other city than these 4 cities. The least of these 3 points will be exempt. We will reduce this amount from HRA. So here we are mentioning 10% of salary, 50% of salary, 40% of salary. What constitutes the term salary while calculating HRA? Salary includes basic salary, DNS allowance if it is provided in terms of employment, if it is part of employment, and commission as a fixed percentage of turnover. There are three components: basic salary, DNS allowance, commission as a fixed percentage of turnover. These three components, we will add them, and the amount so arrived will be considered as salary while computing HRA. While computing the exemption amount under house rent allowance. Exemption is not available to an assessee who lives in his own house or in a house for which he has not incurred the expenditure of rent. If the assessee is living in his own house, there is no rental expense he is paying, and also if he has not incurred any rental expenditure, he will be not eligible to claim any exemption under HRA. We will simply add any HRA amount to the salary while computation of income from salaries, and no exemption will be provided. I hope it is clear for you guys. We will head to the next allowance, which is partly exempt under optional tax regime and fully taxable under default tax regime. As per Rule 2BB, if any allowance is incurred for official purpose, those allowances are helper allowance, research allowance, uniform allowance, traveling allowance, daily allowance, conveyance allowance. I am repeating again: helper, research, uniform, traveling, daily, conveyance allowance. These are incurred for official purposes. Then, when the assessee is paying tax under the optional tax regime, he can claim exemption to certain extent. It could be the actual allowance received or the actual amount spent for the performance of duties of an office or employment of profit, whichever is less. So, least of the actual allowance received from the employer or the actual amount spent by the employee for the performance of official duties will be reduced from the allowance which has been added to the salary previously. First, while computing the salary, if any of these allowances is received by the employee, we will add it. From that, we will reduce the exemption amount, and such exempt amount will be least of either actual allowance received from the employer or actual amount spent by the employee for the performance of official duties. The second type of allowance is incurred for the personal purpose of employer. There are 13 such allowances, and any amount received by the employee in excess of the specified limits will be taxable in his hands as income from the salary for the year. There are 13 allowances, and these allowances are of such nature that if the employee receives such allowances, it should be till certain extent only to claim the exemption. There are threshold limits for each allowance given here, and if the allowance received by the employee is exceeding these limits, these threshold limits, then such excess amount will be taxable. It is not exempt. So, till what extent do these allowances are exempt? Let us see. The first one is special compensatory hilly areas allowance. The special compensatory allowance is generally given when the employee is engaged in any risky venture. Here, when the employee is serving in hilly areas, if he receives any allowance from the employer in the name special compensatory allowance, it can be exempt up to either rupees 800 or 300 per month, depending upon the specified locations. If such employee is serving in Siachen area of Jammu and Kashmir, it is exempted to the extent of rupees 7,000 per month. Special compensatory allowance in the nature of border area or remote locality or difficult area or disturbed area allowances. Rupees 1300 or 1100 or 1050 rupees, rupees 750, 300 or 200 per month, depending upon the specified locations, will be exempt amount. Special compensatory allowance for tribal areas or scheduled areas or agency areas. If employee is serving in these areas, rupees 200 per month is exempt. Any special allowance in the nature of counter-insurgency allowance granted to the members of the armed forces operating in areas away from their permanent locations. Rupees 3,900 per month. When the armed forces members are serving in some other area than their permanent location, in such a case they will be provided with special allowance and it will be exempt to the extent it is paid rupees 3,900 per month only. Any excess amount paid will be taxable. Any special allowance in the nature of island duty allowance granted to the member of armed forces in Andaman and Nicobar and Lakshadweep group of islands. It will be rupees 3,250 per month for the armed forces members who are serving in these areas. Next comes the special allowance granted to the members of the armed forces who are operating in high altitude areas. Depending upon the altitude area, the exemption amount will differ. For the altitude of 9,000 to 15,000 feet, the exempt amount will be rupees 1,060 rupees per month. And for above 15,000 feet altitude, it will be rupees 1,600 per month. Then comes special compensatory allowance in highly active field area. For those who are serving in highly active field area, it will be rupees 4,200 per month. Compensatory field area allowance in specified areas in specified states. We have completed discussing special compensatory allowances. Now we are discussing compensatory field area allowances in specified areas in specified states. It will be rupees 2,600 per month. If it is compensatory modified field area allowance in specified areas in specified states, it is rupees 1,000 per month. The exempt amount will be rupees 1,000 per month. Underground allowance granted to an employee who is working in uncongenial, unnatural climate in underground mines. It is rupees 800 per month. Then comes the allowance granted to employee who is working in a transport system to meet his personal expenditure during his duty performed in the course of running such transport from one place to another, provided that such employee is not in receipt of daily allowance. We are discussing the case where the employee is working in any transport system. To meet the personal expenditure of the employee during his duty performed in the course of running such transport from one place to another place, he will be provided allowance and he is not in receipt of any daily allowance. In such a case, 70% of the allowance amount received by the employee, maximum up to rupees 10,000 per month, will be allowed, will be exempt. 70% of such allowance amount received, maximum limit will be rupees 10,000 per month. Such amount will be exempted. Then comes children education allowance. Children education allowance is permissible maximum up to 2 children only. It will be rupees 100 per month per child, and maximum number of children for whom the employee can claim such exemption is 2 children only. Rupees 100 per month per child, he can claim the exemption. Any allowance granted to an employee to meet the hostel expenditure on his child. For hostel expenditure, it will be the maximum permissible number of children will be 2 children and the amount will be rupees 300 per month per child. So we have completed discussing allowances. One thing about heads of income is really a test for our memory power. I hope you all have understood all these allowances. The 4 categories: one is fully taxable under both regimes, fully exempt under optional tax regime only, fully exempt under both, and partially exempt under optional tax regime, fully taxable under default tax regime. After discussing these 4 categories of allowances, let us head to our next component of salary, that is perquisite. The fifth component which we add in computation of salary is perquisite. Perquisite may be a monetary or non-monetary benefit or any advantage extended by the employer to the employee. These perquisites are of three categories. Number 1, tax-free perquisites. Number 2, perquisites taxable for all. And then comes perquisites taxable for specified employees only. Let us discuss them one by one. The first category of perquisites, that is tax-free perquisites. Since there is a long list of tax-free perquisites, I have made a code, that is RTP cube, E square C and SLM. You guys must have known SLM in straight line method, right? So I hope it will be easy for you to remember what are the tax-free perquisites. The list of tax-free perquisites are RTP cube, E square C and SLM. What does R cube stand for? Refreshment, recreational facilities, rent-free official residence. Then comes T cube, telephone, transport facility and amount spent on training of employees. P cube stands for privilege passes and privilege ticket. Annual premium by the employer on personal accident policy, perquisites allowed outside India by the government. So RTP cube stands for 3 R's, refreshment, recreational facilities, rent-free official residence. 3 T's, telephone, transport facility, amount spent on training of employees. 3 P's, privilege passes and privilege ticket, annual premium by the employer on personal accident policy, perquisites allowed outside India by the government. Then comes E square, that is employer contribution to staff group insurance scheme, and then sum payable by the employer to a recognized provident fund or an approved superannuation fund. C stands for conveyance facility. So the next tax-free perquisite is SLM, subsidized lunch, leave travel concession and medical facilities. I hope this code will be helping you to some extent at least to remember the tax-free perquisites. What are the tax-free perquisites? 3 R's, 3 T's, 3 P's, 2 E's, C and SLM. There are few important points which we have to discuss regarding the tax-free perquisites, leave travel concession and medical facilities. Let us discuss what are those important points. The leave travel concession. Leave travel concession is generally extended to employees who are taking leave to travel to any places in India. It is applicable only for individuals who are opting to pay tax under normal provisions of tax. That is, if he is opting out of the default tax regime, he can claim exemption under leave travel concession. It is extended to citizens as well as non-citizens who are proceeding to any place in India. The leave travel concession expenses may be extended for the assessee or employee himself or herself and for his or her family who are traveling along with the assessee. Here the family includes spouse of such employee, his children and parents, brothers, sisters who are wholly or mainly dependent on such individual. The spouse and children of the individual as well as his parents, brother and sister if they are wholly or mainly dependent on the individual. Then they will come under the definition of family for the purpose of calculating leave travel concession. Remember one important point here. The exemption referred to shall not be available to more than 2 surviving children of an individual born after 1st October 1998. And also, in respect of children born before 1st October 1998, this exemption is not allowed. This exemption shall not apply for children who are born before 1st October 1998. It is applicable only for children who are born after 1st October 1998, and that too maximum 2 surviving children. And also in case of multiple births after one child, that is, after one child is born, the individual is having twins or triplets. In such a case, such concession will be eligible to be claimed for that one child only. The exemption in all cases will be limited to the amount actually spent. The leave travel concession exemption will be limited to the amount actually spent, but the employee cannot spend expenses on while he is traveling extravagantly. So there are few conditions which tell us the limits up to which the employee can spend the amount while traveling to such places. So what are the limits till which the employee can spend the amount while traveling? The first one, if the journey is performed by air. He has chosen Airways to travel in India. The limit of amount exempted will be, we have to consider we have to see that the employee has opted for shortest route to reach the destination. If he is going through Airways, the amount of exemption will be amount not exceeding the air economy fare of the national carrier. If the employee is traveling through any other mode, he will either choose railways. If the employee has chosen rail services, in such a case, amount not exceeding the air conditioned first class rail fare will be allowed as exemption. Let us suppose the rail service is not available and the employee is traveling through public transport system, a recognized public transport system. In such a case, amount not exceeding first class or deluxe class fare will be the maximum amount of exemption. Let us consider a case where a recognized public transport system doesn't exist too. In such a case, the amount equivalent to the air-conditioned first-class rail fare, as if the journey has been taken place in rail, will be allowed as exemption. I hope it is clear. Now let us head to the next tax-free perquisite, that is medical facilities. Any medical treatment to the employee and family members. The expenses incurred on any medical treatment of employee and his family members will be exempt in following cases. We are considering medical facilities as tax-free perquisite, but subject to these following conditions. It will be exempt if the medical treatment has taken place in the hospital maintained by the employer. If the medical treatment has taken place in the government or government approved hospital. If the medical treatment has taken place in respect of any prescribed disease or ailments in any hospital approved by the principal chief commissioner or chief commissioner, and in respect of any illness relating to COVID-19. So there are 4 cases. Either the medical treatment should take place in the hospital maintained by the employer, or the medical treatment has been taken place in government or government approved hospital, or the medical treatment is regarding any prescribed disease or ailment suffering either by employee or his family members in any hospital approved by the principal chief commissioner or chief commissioner. Then comes the 4th case. In respect of the medical treatment is in respect of any illness relating to COVID-19. 4 conditions: hospital should be maintained by the employer, or hospital is government or government approved hospital, or any prescribed disease or ailment which he is suffering from or his family member is suffering from, and the treatment has been taken place in hospital approved by chief commissioner. Then comes treatment regarding any illness relating to COVID-19. In these 4 cases, medical facilities, the expenses spent on medical facilities for which employer pays for the employee will be tax-free perquisite. Relating to the COVID-19 point, there are few conditions. The COVID-19 positive report of the employer family member should be provided. All necessary documents of medical diagnosis or treatment for the COVID-19 or illness related to COVID-19 suffered within the 6 months from date of being determined as COVID-19 positive are to be produced. The necessary documents of medical diagnosis as well as the treatment. The documents regarding these two things should be provided, and the time limit will be within the 6 months from date of being diagnosed with COVID-19. A certification in respect of all expenditure incurred on the treatment of COVID-19 or illness related to COVID-19 should be produced. First, COVID-19 positive report, then comes the medical diagnosis or treatment, all the documents relating to the medical diagnosis or treatment, then comes certification in respect of expenditure incurred for the treatment of illness related to COVID-19 or COVID-19. Here, the family members of employee include his spouse, children whether they are dependent or not, and dependent parents, brothers and sisters. If the parents and brothers and sisters of the employee are fully dependent on him, only in such a case he can claim any medical expenditure incurred on them as tax-free as a tax-free perquisite when the employer pays for such expenses. There may be certain cases where the medical treatment has been provided to the employee or his family members outside India. In such a case, any expenditure incurred by the employer or any sum paid by the employer on any medical treatment, travel and stay abroad of one attendant who accompanies the patient. Such expenditure will be considered, when it is paid by the employer, it will be considered as tax-free perquisite. The expenditure includes the medical treatment expenses as well as the expenses incurred for the traveling and staying abroad, and not only for the patient, the one attendant who is accompanying patient, it will be limited to only one attendant. So to that extent, any medical expenditure incurred by the employer or any sum paid by the employer regarding these three expenses will be considered tax-free perquisite even if the treatment has taken place outside India. The perquisite element in respect of expenditure on medical treatment and stay abroad will be exempt only to the extent permitted by the RBI. Then the expenses in respect of travelling of the patient and the attendant will be exempt if the employee's gross total income including the said expenditure does not exceed rupees 2 lakh. Remember these 2 points. With this, we have completed discussing first category of perquisites, that is tax-free perquisites. Now let us head to the next category of perquisites which are taxable for all. The perquisites which are taxable for all the employees. The first one is value of rent-free accommodation provided to the employee. Similarly, the second perquisite is value of any accommodation provided to the employee at a concessional rate. Let us discuss these two first. So coming to our first taxable perquisite, that is value of rent-free accommodation. Rent-free accommodation means the accommodation is provided to you, to the employee by the employer himself. The accommodation might be owned by the employer himself. It is his own premises, or the employer will take such premises on hire so that he can provide you accommodation. Such accommodation can also be either furnished or unfurnished. If the house is furnished, the house which has been provided by the employer to you is furnished, then the perquisite value, the perquisite value shall also include value attributable towards the furniture. What is the value attributable towards the furniture? We have already discussed that the employer might own the accommodation. In such a case, if the employer owns such furniture also, the value of perquisite will be 10% per annum of cost of furniture. Here we are providing for any wear and tear on such furniture. If the furniture is owned by the employer, 10% per annum of cost of furniture will be the perquisite value attributable towards the furniture. Let us take a case where the employer hires such furniture. It is not his own furniture. In such cases, hire charges will be the perquisite value attributable towards the furniture. This is not the whole perquisite value. This is a part of value of rent-free accommodation only when the accommodation is furnished. If the accommodation is not furnished, there will be no perquisite value attributable towards the furniture. So, let us take a case when the employer is central government or state government. When the employer is central government or state government. In such a case, the value of perquisite will be simply license fee plus any furniture perquisite if it is furnished accommodation. We know that what is the value attributable towards the furniture perquisite. We have discussed it just now. So, the value of perquisite will be license fee plus furniture perquisite if the accommodation is furnished when the employer is central government or state government. When it is other employer than CG or SG. In such a case, if the accommodation is owned by the employer, there will be two cases here. The first case is the accommodation is owned by the employer himself. The second case is the accommodation will be taken on lease or rent by the employer. The first case where the accommodation is employer's own premises. In such a case, 15% or 10% or 7.5% of salary in respect of period of occupation of accommodation plus the furniture perquisite will be the value of rent-free accommodation. The perquisite value will be either 15% or 10% or 7.5% of salary in respect of period of occupation of accommodation plus furniture perquisite if the accommodation is furnished. What is this 15%, 10%, 7.5%? Depending upon the population in the city as per the 2001 census. If the population in such city where the employee has been provided the accommodation, if the population is less than 10 lakh, in such a case 7.5% of salary will be the perquisite value. If the population exceeds 10 lakh and it is less than 20 or equal to 25 lakh, in such a case 10% of salary will be the perquisite value. If the population exceeds 25 lakh residents, 15% of salary will be the perquisite value. I hope it is clear for you. So, to this perquisite value, we will add any furniture perquisite if the house is furnished. This is the case when the employer is the owner of the house, the accommodation provided to the employee. Let us take the case where the employer has taken the house on lease or rent so that he can accommodate for the employee. In such a case, lower of lease rental payable or paid by the employer or 15% of salary. Either the lease rent paid or payable by the employer on such accommodation or 15% of salary of employee, whichever is less, will be the perquisite value. To this, we will add any furniture perquisite value if the house is furnished. Here we have taken 10% on salary, 7.5% on salary or 15% of salary. So, what constitutes the salary while calculating the rent-free accommodation, the perquisite value for the rent-free accommodation? Salary here includes basic salary, dearness allowance if it is forming part of retirement benefits, all taxable allowances, bonus, fee or commission, and any other monetary payment by whatever name called from one or more employers. will be taken under the definition of salary. We will add all these components and the amount so arrived will be the salary, which will be used for calculation of perquisite value under the rent-free accommodation. Let us revise it once again. When the owner of the house or accommodation is the employer himself, the perquisite value will be 7.5% or 10% or 15% depending upon the population of the city in which such accommodation is situated. To this, we will add the furniture perquisite. If the employer hires takes such accommodation on lease or rent, so he can accommodate for the employee. Either the lease or rent paid or payable by the employer, or 15% of salary, whichever is less, will be the perquisite value. To this we will add the furniture perquisite. The salary includes basic salary, DA forming part of retirement benefits, all taxable allowances, bonus, fee or commission, and any other monetary payment by whatever name called from one or more employers. So this is how we calculate the perquisite value under rent-free accommodation. There are few important points we have to remember regarding rent-free accommodation. The first point, when the accommodation is provided at two places, the same employer is providing to the same employee accommodation at two different places. It may be because of transfer or shifting of employees' place of work. If the accommodation is retained at one place and the employee is transferred to new place where another accommodation has been provided, up to 90 days, only one accommodation which is of lower value is taxable, and beyond 90 days both are taxable. The case is employee is residing in one city where the employer has provided him accommodation. Now he is transferred to another place, and there too the employer is giving him accommodation, while still the employee is retaining the previous accommodation which is given in the other city. In such a case, both these accommodations will be regarded as perquisite. For up to 90 days, only one accommodation which is of lower value is taxable. Up to 90 days, the employee, it will take time for employees, his family to shift from that previous place to the new place, right? So up to 90 days, only one accommodation which is of lower value is taxable. And beyond 90 days, whatever perquisite value for both the accommodations is there, it will be taxable. Accommodation provided in remote area for mining site or onshore oil exploration site, dam site, power generation site. These are risky areas or remote areas, so such perquisite will be exempt. Rent-free accommodation perquisite value will be exempt if the accommodation is provided in remote areas such as mining site, onshore oil exploration site, dam site or power generation site. Rent-free accommodation provided to judge of High Court or Supreme Court is exempt under the optional tax regime. If accommodation is provided at a hotel, including for government employees, if the accommodation is provided at a hotel, not in a house, the value of such perquisite will be lower of actual hotel charges or 24% of RFS salary. RFS salary, as we have discussed above, such 24% of such salary or actual hotel charges, whichever is lower, will be the value of perquisite if the accommodation is provided at hotel, including for government employees. So these are few important points which we have to remember regarding the rent-free accommodation. This perquisite value, whichever we have computed now, will be added in computation of salary, and such perquisite value will be taxable in the hands of employee. So we have discussed the rent-free accommodation. Rent-free accommodation. Suppose the accommodation is provided at a concessional rate, not full free. It is provided at a concessional rate. In such a case, the taxable value of perquisite will be calculated as above. and any amount recovered from the employee will be reduced. In the above case, the accommodation is provided free of cost. It is rent free. Now, the accommodation is provided at a concessional rate. That means employee has paid certain amount towards such provision of accommodation. In such a case, the value of perquisite will be simply we will calculate as if the accommodation is rent-free accommodation. From such, any amount recovered from the employee will be deducted. Such amount will be taxable value of perquisite when the accommodation is provided at a concessional rate, and such taxable value will be added in computation of income from salaries of the employee. I hope this is clear for you. With this, we have discussed the first two taxable perquisites: value of rent-free accommodation and value of accommodation provided at concessional rate. The third taxable perquisite is obligation of employee discharged by the employer. When any amount is paid by the employer in respect of any obligation which otherwise would have been paid by the employee himself. Employee is obliged to pay any amount, but instead of employee, the employer is paying such amount on behalf of employee. In such a case, such amount will be taxable perquisite. The obligation of employee discharged by the employer is a taxable perquisite. The fourth point, any sum payable by the employer to effect an assurance on the life of the employee or to effect a contract for annuity. The actual expenditure or sum incurred by the employer to effect an assurance of life assurance of the employee, or to effect any contract for annuity for the employee will be taxable perquisite. The fifth perquisite is amount or aggregate of amounts of any contribution made by the employer to the account of assessee in any RPF, recognized provident fund, in an NPS, an approved superannuation fund to the extent it exceeds rupees 7,50,000. Here, the employer is making any contribution on behalf of his employee. The employer is making contribution on account of assessee, his employee, and the amount or aggregate of such amount towards the recognized provident fund, NPS, or any approved superannuation fund is up to rupees 7,50,000. It will be tax free. But if such amount exceeds rupees 7,50,000, to the extent it exceeds rupees 7,50,000, that is, the excess amount will be considered as taxable perquisite. Any amount which is in excess of rupees 7,50,000 contributed by the employer on the account of employee towards these three funds will be taxable perquisite. The sixth perquisite is annual accretion to the balance at the credit of recognized provident fund or NPS or approved superannuation fund which relates to the employer's contribution and included in total income on account of the same having exceeded rupees 7,50,000. This point is related to the above fifth perquisite, that is contribution made by employer towards employee for these three funds, RPF, NPS or superannuation fund. Here we have discussed that if it exceeds rupees 7,50,000, it will be taxable perquisite. Here the case is the employer contribution has exceeded rupees 7,50,000. On such exceeded amount, there is an annual accretion. So regarding this, we will discuss in detail. The annual accretion means it might be any interest amount or dividend amount or any other income earned on such excess amounts shall also be taxable, which means the annual accretion means any interest, dividend or other income earned by the employee on such excess amount, the amount exceeding rupees 7,50,000 will be taxable. Here the employer has contributed amount exceeding rupees 7,50,000, and any amount exceeding that rupees 7,50,000 has earned any interest, dividend or other income for the employee. Such amount will also be taxable. But how should we calculate the taxable perquisite for such annual accretion? This is the important point which we have to pay attention to. The taxable perquisite is PC by 2 into R plus PC1 plus TP1 into R. Let us discuss these terms one by one. From the formula, taxable perquisite, TP means taxable perquisite under section 17 for the current previous year. That means for the previous year, what is the taxable perquisite we are calculating, and the other terms are PC. PC means employer contribution in excess of rupees 7,50,000 during the previous year. Any amount over and above rupees 7,50,000 contributed by the employer during the previous year is PC. If the employer has contributed any amount over and above rupees 7,50,000 in previous years commencing from previous year 2021 onwards, so we have to see PY 2020 21, 2021 22, 2021 23, 2022 23. Like that, we have to see if there is any excess contribution by the employer than rupees 7,50,000. Such amount will be PC1. TP1, the aggregate of taxable perquisite under section 17 for PYs commencing from the PY 2020-21 onwards. That means if the employer has in any previous year starting from 2020-21, the employer has contributed amount exceeding rupees 7,50,000. On such excess amount, there will be some annual accretion, and it is considered as taxable perquisite. Now, such taxable perquisite is now called as TP1 while calculating the taxable perquisite for this year. The taxable perquisite of previous years commencing from 2020-21 is called TP1. Aggregate of such all taxable perquisites in previous years is called TP1. Then comes I. I means amount or aggregate of amounts of income accrued in the funds during the current previous year. Next comes FAVG. It is nothing but calculation of average, that is the opening balance of such fund plus closing balance of the fund divided by 2. The next term is R. R is nothing but rate. R is calculated by taking I divided by FAVG. Let us solve one question from our institute material to understand this concept clearly. Mr. X is appointed as a CFO of ABC Limited in Mumbai from 1st September 2021. His basic salary is rupees 6 lakh per month. He is paid 8% as DNS allowance. He contributes 10% of his pay and DA towards his recognized provident fund, and the company contributes the same amount. So Mr. X is CFO of ABC Limited. He from 1st September 2021. His basic salary is 6 lakh per month and 8% is DA. 10% of his basic salary plus DA is his contribution towards recognized provident fund. The same amount which the employee Mr. X is paying towards the recognized provident fund is also contributed by his employer, that is the company ABC Limited. The accumulated balance in recognized provident fund as on 1st April 2022, 31st March 2023, 31st March 2024 is rupees 9,81,137, rupees 27,43,048 rupees and rupees 46,48,555 respectively. Compute the perquisite value chargeable to tax in the hands of Mr. X under section 17 clause 2 for the assessment year 2023-24 and assessment year 2024-25. Prior to 1st September 2021, he was a consultant whose professional fee was taxable under the head PGBP. So, from the above information, first let us calculate what is the salary of employee, Mr. X. The salary is 6 lakh per month. That is 6 lakh into 12 months, plus he said the 8% is dearness allowance. So 8% on 6 lakh into 12 months, which totals to rupees 77,76,000 per annum. This is the salary of Mr. X. Now, the employee contribution, Mr. X has contributed 10% of this amount towards RPF, and the same amount has also been contributed by the employer, that is ABC Limited. So 10% of above amount is rupees 7,77,600 each. Employee has contributed, Mr. X has contributed 7,77,600. And also his employer ABC Limited has also contributed 7,77,600 towards the RPF. In the year 2021-22, the employee Mr. X has worked under ABC Limited for 7 months only, starting from 1st September 2021. So let us calculate the employer contribution proportionately for this year. 7 months divided by 12 months into 7,77,600 will be rupees 4,53,600 each. So in the year 2021-22, the contribution of employer has not exceeded rupees 7,50,000. I have clearly made a table. In the year 2021-22, employee contribution is 4,53,600. Employer contribution is also the same, 4,53,600. Here, from the question, it is clear that the closing balance, that is balance as on 1st April 2022, is 9,81,137. Interest amount. How should we calculate the interest? Here we have what is the amount contributed by employee, what is the amount contributed by employer. We have closing balance. Simply reducing the employer contribution and employee contribution from the closing balance, we will get the interest amount which has been accrued, the annual accretion on such contribution to RPF. So closing balance minus employer contribution minus employee contribution minus opening balance, if any, will be our interest earned during the period of 2021-22. I hope it is clear for you guys. I hope you guys are able to understand what I am trying to say. So the interest is calculated by reducing employer contribution, employee contribution and opening balance from closing balance. Coming to the next year, 2022-23, we know that employer contribution will be 7,77,600. Same will be the employee contribution also. 10% of salary amount will be the contribution towards RPF. The opening balance for year 2022-23 will be carried forward closing balance of year 2021-22, 9,81,137. Employee and employer contribution will be 7,77,600 each. The closing balance is given in question as 27,43,048 rupees. Interest will be 4 minus 3 minus 2 minus 1, that is 2,06,711 is the interest which has been accrued during the year 2022-23. We know that we have to calculate FABG, that is the average of opening and closing balances. Opening balance 9,81,137 plus closing balance 27,43,048 rupees divided by 2 will total to the amount 18,62,093 rupees. Now let us calculate the rate R. R is I, interest, divided by F, average. That is 2,06,711 divided by 18,62,093 rupees. 0.11101 is the rate. For the year 2024-25, the opening balance, for the year 2023-24, the closing balance from the previous year will be the opening balance, that is 27,43,048 rupees. Employer and employee contribution will be the same, and the closing balance as given in question is 46,48,555. Here the interest will be the same, 4 minus 3 minus 2 minus 1, that is 3,50,307 rupees. This is the interest accrued during the year 2023-24 on the contribution made by the employee and employer respectively. Now, F average will be the average of opening and closing balances, that is 36,95,802. R is equal to I by F average, that is 0.09479. We know the formula. Taxable perquisite is equal to PC, the employer contribution, divided by 2 into R plus PC1 plus TP1 into R. PC is employer contribution in excess of rupees 7,50,000. PC1 is in any previous year if the employer has contributed amount exceeding rupees 7,50,000, that is PC1, and TP1 is any annual accretion, any taxable perquisite on such excess contribution by employer is nothing but TP1. We have calculated R for each year, for the year 2022-23 and year 2023-24. For the assessment year 2023-24, that is previous year will be 2022-23. What is the taxable perquisite from the annual accretion? Let us see. TP means, here PC means excess of the employer contribution which is exceeding rupees 7,50,000. So 7,76,600 is employer contribution. The excess amount means 7,77,600 minus 7,50,000 divided by 2 into R for the year assessment year 2023-24 will be 0.11101 plus any contribution made by employer which is exceeding rupees 4,50,000 starting from PY 2020-21 is PC1, and any taxable perquisite on such excess contribution will be TP1. Here it is clearly mentioned in the question that the employee Mr. X was consultant before being employed by the ABC Limited and his professional fee was taxable under PGBP. That means this is his first time contribution towards RPF. So then, since there is no contribution in the previous years, that too any contribution exceeding rupees 7,50,000 is not there. So we are taking PC1 and TP1 as 0 for assessment year 2023-24. Simply the taxable perquisite for this year will be rupees 1,532. PC1 and TP1 are nil since employer contribution in preceding years did not exceed rupees 7,50,000. The interest on aggregate of following will also be charged to tax during the assessment year 2023-24. We have to note this point that the interest on 2,03,600, that is employee. There is one point I should have discussed before. Here the employee is contributing towards the RPF, and if any interest earned by the employee on such contribution exceeding rupees 2,50,000 will be taxable. It will be chargeable to tax. Employee contribution exceeding rupees 2,50,000 during the previous year 2021-22 is rupees 2,03,600. That is simply 4,53,600 minus 2,50,000, 2,03,600. On this amount, there will be interest accrued in the previous year 2021-22. It is chargeable to tax. Now, employee contribution exceeding rupees 2,50,000 during previous year 22-23. That is 7,77,600 minus 2,50,000, which is rupees 5,27,600, will also be chargeable to tax. The interest on these two amounts will be chargeable to tax during the assessment year 2023-24. Similarly, interest accrued on rupees 2,03,600 being excess employees contribution during previous year 2021-22 will also be chargeable to tax in assessment year 2023-24. Simply put, in previous year 2021-22, the employee must have earned interest on such excess amount, and this interest will be retained back into the same RPF. It is still it is still included in the RPF. In such a case, on such amount, interest will be earned during the previous year 2021-22 as well as in the previous year 2022-23 also. On the interest amount, interest will be earned. I hope you are able to understand what I am trying to convey. First, the interest on aggregate of the interest on rupees 2,03,600 and the interest on 5,27,600 will be taxable. Now, the interest accrued in the previous year 2021-22 on 2,03,600 will be retained in the same RPF, and on such interest amount, again the interest will be accrued this year also, no. So, such interest will be taxable in the assessment year 2023-24 also. Not only the interest accrued in previous year 22-23, but also the interest on the interest accrued in the previous year 2021-22 will also be taxable. I hope you are able to understand. Coming to the next assessment year 2024-25, let us calculate the taxable perquisite. Taxable perquisite is rupees 7,77,600 minus 7,50,000, the excess employer contribution PC1 divided by 2 into R for the assessment year 2024-25 is 0.09479 plus PC1 will be 27,600. In the previous year, the employer has contributed 7,77,600. That means 27,600 is excess contribution by the employer. And on such excess contribution, the taxable perquisite earned is rupees 1,532 rupees. That we will include here as TP1. To this we will multiply with R 0.09479. The amount is rupees 4,069 rupees. So this is the taxable perquisite for the assessment year 2024-25 on annual accretion on the employer contribution exceeding rupees 7,50,000 towards RPF, NPS or superannuation fund. Coming to the interest part. Interest on excess contribution of rupees 2,03,600. Interest on excess contribution of rupees 5,27,600 for previous year 2022-23. Interest on excess contribution of rupees 5,27,600. Here excess contribution of interest will be rupees 2,50,000 only during the previous year 2023-24. Interest on these excess contributed amounts will be chargeable to tax. Similarly, the interest which has been accrued in previous year on the excess amount of rupees 2,03,600 as well as rupees 5,27,600. The interest amount on these interests accrued in previous years will also be chargeable to tax in assessment year 2024-25. I hope I'm able to make you understand this concept at least to some extent. With this, we have completed discussing the fifth taxable perquisite. So, coming to the next taxable perquisite, that is specified security or sweat equity shares allotted or transferred by the employer free of cost or at concessional rate to the assessee. If we discuss this in detail, when the assessee has been allotted or transferred any specified security or sweat equity shares by the employer free of cost or at a concessional rate, then it is considered as a taxable perquisite. The value of perquisite is fair market value of the shares minus amount recovered from employee. It will be taxable at the time of allotment of such securities. So how to determine the fair market value of the shares? To calculate the value of perquisite, we have to determine the fair market value of shares as follows. There might be listed securities or unlisted securities. If the shares are listed securities and they are listed on one stock exchange, then we take the fair market value of shares as average of opening and closing price. If the shares are listed on multiple stock exchanges, then the average of opening and closing price where highest volume is traded is the FMV of shares. In case of unlisted securities, it will be the FMV will be as determined by the merchant bankers. When buying and selling prices both are given, consider only selling price for computation. To determine fair market value of shares, in question if the buying and selling prices both are given, we have to take only selling price. The average opening and closing selling price should be taken for computation of fair market value of shares. If on exercise date no trading has taken place, then consider the closing price of nearest date. Now that we have discussed all the taxable perquisites, there are few more fringe benefits or amenities which are considered as taxable perquisites. Let us go through each of them one by one. Any other fringe benefit or amenity which are considered as tax-free perquisites, they are, the first one is interest-free or concessional loan. When employee has been provided with loan by the employer, it is considered as a perquisite. The taxable value will be bank interest rate minus interest charged by the employer. Here the employer is either giving interest free loan or a concession on the interest. In such a case, the value of perquisite will be bank interest rate minus interest charged by the employer. The bank interest rate should be considered the rate of SBI on the first day of previous year in which the loan is taken. The value of perquisite is exempt if the loan amount is petty, that is, it is not exceeding rupees 20,000 in aggregate, and if the loan is taken from the employer by the employee for any medical treatment of self or family member, then it is not considered as a taxable perquisite. It will be exempt. If employee subsequently recovers any claim from insurance company, then the perquisite will be taxable. So, for interest-free or concessional loan, the value of perquisite will be bank interest rate, that is the SBI rate on first day of previous year in which the loan is taken, minus the interest charged by the employer. If the loan amount is petty, not exceeding rupees 20,000 in aggregate, then it is exempt. And if it is borrowed for medical treatment of self or family member of the employee, then it will be exempt. The next benefit, traveling, touring and accommodation. if traveling, touring and accommodation etc. expenses are paid or reimbursed by employer. The value of perquisite is as follows. Where such facility is available uniformly to all employees, the expenditure incurred by the employer will be the value of perquisite taxable. If such facility is not uniformly available for all the employees, the value at which such facilities are offered to general public by other agencies will be the value of perquisite, which is taxable. If it is provided uniformly to all employees, the expenditure actually incurred by the employer is the value of perquisite. But if such facility is not available uniformly to all the employees, then the value at which such facilities are offered by the other agencies to the general public will be the value of perquisite. Where the employee is on official tour and the expenses are incurred in respect of any family member accompanying him, the amount of expenditure so incurred shall also be a fringe benefit or amenity. Any amount of expenditure paid in respect of any family member by the employer will also be treated as fringe benefit or amenity. If the official tour is extended as a vacation, the value of such fringe benefit shall be limited to expenses incurred in relation to such extended period of stay or vacation. The amount so determined shall be reduced by the amount, if any, paid or recovered from the employee for such benefit or amenity. For these perquisites, if any amount is recovered from the employee by the employer, then while calculating the value of perquisite, we will reduce such amount recovered from the employee. The next benefit is free or concessional food and non-alcoholic beverages. The value of taxable perquisite is the amount of expenditure incurred by such employer minus amount paid or recovered from the employee. The amount of expenditure incurred by the employer minus amount paid or recovered from the employee is the value of perquisite for free or concessional food and non-alcoholic beverages. But the following cases are not to be treated as a perquisite. If the free food and non-alcoholic beverages are provided by such employer during the working hours at office or business premises itself, and when it is the payment for the free food and non-alcoholic beverages is paid through paid vouchers, which are not transferable and usable only at the eating joints. The third case is to the extent the value thereof either case does not exceed rupees 50 per meal. When the value of free food or non-alcoholic beverages does not exceed rupees 50 per meal, it is not to be treated as a perquisite. If tea or snacks are provided during the working hours, and if free food or non-alcoholic beverages during working hours provided in a remote area or an offshore installation, in these three cases, it is not treated as a perquisite. The amount of expenditure incurred by the employer in these three cases on food and non-alcoholic beverages should not be treated as a perquisite and is hence not taxable. The fourth benefit, gift, voucher or token in lieu of such gift received by the employee or by member of his household on a ceremonial occasion or otherwise from the employer, then the value of perquisite will be sum equal to amount of such gift. Any gift, voucher or token in lieu of such gift received by the employee or his or member of his household during any occasion, then the value of perquisite will be sum equal to amount of such gift. And the value of gift, if it is below rupees 5,000 in aggregate, then the value of perquisite shall be taken as nil. So the value of gift, if it is below rupees 5,000, it will not be a taxable perquisite. Credit card expenses. Value of perquisite is the amount of expenses including membership fee and annual fee incurred by the employee or any member of the household, which is charged to a credit card paid or provided for or reimbursed by the employer, minus any amount paid or recovered from the employee. We have to reduce any amount recovered from the employee or paid by the employee from the amount of expenses including the membership fee, annual fee, which is incurred by the employee or any member of his household, which is charged to the credit card, and such credit card should be paid or provided for or reimbursed by the employer. Expenses are incurred by employee or any member of his household on the credit card, and such credit card is being provided or by or reimbursed by the employer. This perquisite will be exempt if it is incurred wholly or exclusively for official purposes and employer certifies so. The employer should also maintain complete details in respect of such expenditure, including the date and nature of expense so incurred. Club expenditure. The value of perquisite is simply the amount of expenses including periodical fee and annual fee which is incurred by employee or member of his household in a club. It is paid or provided for or reimbursed by the employer. Expenses are incurred including the periodical fee and annual fee by the employee or any member of his household. In a club, it will be paid or provided for or reimbursed by the employer. From this amount, we will reduce any amount paid or recovered from the employee, and such amount will be treated as the taxable value of perquisite. Where the employer has obtained corporate membership of the club and the facility is enjoyed by the employee or any member of his household, the value of perquisite shall not include the initial fee paid for acquiring such corporate membership. And also, the perquisite will be exempt if it is incurred wholly and exclusively for the business purpose and the employer certifies so. The employer should also maintain complete details in respect of such expenditure, including the date and nature of such expenditure. There would be no perquisite for use of health club, sports and similar facilities provided uniformly to all the employees by the employer. If there will be no perquisite if the employer uniformly provides to all employees any expenditure incurred on the health club, sports and similar facilities. Coming to the next benefit, that is use of movable assets. Any asset is given by the employer to the employee. For example, any laptop or computer, the value of perquisite will be nil. But if it is a movable asset other than laptop and computer, then 10% per annum of actual cost of such asset or the amount of rent or charge paid or payable by the employer as the case may be, minus amount recovered from the employee will be the value of perquisite. Here simply 10% of actual cost of such asset means the wear and tear attributable on such asset. Or if the employer has taken such asset on hire and giving it to the employee, the amount of rent paid or charge paid by the employer will be the value of perquisite. And if any amount is recovered from the employee, we will deduct such amount. Transfer of movable assets. Here the above point is use of movable assets. It is not a transfer. But here the next point is transfer of movable assets. That means the ownership is going to the employee. Value of perquisite will be depreciated value of asset minus amount paid or required from the employee. How to calculate the depreciation on the asset? It is calculated for each completed year of usage at following rates. For computers and electronic items, the rate of depreciation will be 50% and calculated on written down value basis. For motor cars, it is 20% rate of depreciation and it will be calculated on written down value basis. For any other asset than computer, electronic items or motor cars, if it is transferred to employee, the rate of depreciation will be 10% and it will be calculated on straight line method basis. The amount so arrived will be depreciated value of asset. From that we will deduct amount paid or recovered from the employee, and such amount will be value of perquisite. With this we have completed taxable perquisites for all employees. Let us now discuss the next category. The next category of perquisites, that is Perquisites taxable for specified employees only. There are 5 perquisites. The first one is provision of sweeper, gardener, watchman or personal attendant. Facility of use of gas, electricity or water supplied by the employer. Free or concessional tickets, use of motor car and free or concessional educational facilities. These perquisites, if they are extended, these facilities, if they are extended to specified employees, then they are taxable. Let us discuss them one by one. Before we discuss the perquisites, those 5 perquisites, let us first go through the definition of specified employee. Specified employee means the assessee is either full-time or part-time director. Other than being the employee of the company, he is full-time or part-time director. It does not matter if he is director throughout the previous year or not. If he serves as director a part of previous year also, he will be considered specified employee. He has substantial interest in the company. Substantial interest means he is beneficial owner of equity shares which are carrying 20% or more voting power in the company. Legal ownership doesn't matter. Here, beneficial ownership of equity shares carrying 20% or more of voting power in the company is considered to be the substantial interest in the company. And if such employee, if such assessee draws salary in excess of rupees 50,000, he is specified employee. Salary for this purpose includes basic salary, DNS allowance, commission, bonus, fee, plus any other taxable payment or allowances, any other monetary benefits, minus deductions under section 16. After adding all these components and providing for deductions, still the specified employee, still the assessee is able to draw salary exceeding rupees 50,000. Then he will be considered as specified employee of the company. So what are the perquisites? The taxable perquisites for specified employees. The first one is provision of sweeper, gardener, watchman or personal attendant. Value of benefit will be, the value of perquisite will be actual cost incurred by the employer in providing such a sweeper or gardener or watchman minus any amount recovered from the employee or paid by the employee. If the servant engaged by the employee but wages are paid or reimbursed from the employer, it will be perquisite for all employees. If the servant is engaged by the employer and wages are paid or reimbursed from the employer, it will be perquisite for specified employees only. That means if the servant is engaged by the employer himself and he is the one who is paying wages for such servant, it will be perquisite for specified employees only. Facility of use of gas, electricity or water supplied by the employer. When any facility regarding the gas, electricity or water is provided by the employer, the circumstances may be that if there is an agency and employer is paying such agency so that these facilities are provided to his employee. In such a case, the value of perquisite will be amount paid by the employer to such agency minus amount recovered from the employee. If the supply is made from resources owned by the employer himself, that means the facility of gas, electricity or water are supplied from the resources of the employer himself, then the manufacturing cost per unit incurred by the employer minus amount recovered from the employee will be the value of perquisite. If gas, electricity or water connections are taken by the employee on his own, but the expenses are paid or reimbursed by the employer, it is perquisite for all employees. In cases where these facilities are taken in the name of employer and expenses are also paid or reimbursed by the employer, it will be a perquisite for specified employees only. Free or concessional tickets. The value of perquisite will be value charged by the employer for such benefits to the public in general minus any amount paid by the employee. The condition for this benefit is the employer should be engaged in any carriage of passengers or goods. the service provided to employee or his household is at free of cost or at a concession for the employee's personal or private journey. The service provided through any conveyance owned, leased or made available by any other arrangement by such employer. Employer is either providing his own conveyance or he is leasing or making available such arrangement for the conveyance of employee or his household either at free of cost or at concession for employee's personal or private journey. And the employer should have been engaged in the carriage of passengers or goods. In such a case, the value of perquisite will be the value charged by the employer for such services to general public minus any amount paid by the employee. No such perquisite to the employees of an airline or the railways. That means there is no such benefit or a amenity which will be extended to the employees of an airline or railways. Valuation of free or concessional educational facilities. The circumstances where free or concessional educational facilities are provided by the employer to his employee are if the educational institution is maintained and owned by the employer himself and he is providing educational facilities free of cost or at concession to the children of his employee. Or if free educational facilities are allowed in any other educational institution by the reason of his being in employment of that employer. Since the assessee is employed under such employer, the assessee is able to get free or concessional educational facilities for his children. By the reason of employment, he is getting such facilities. In these two cases, the value of perquisite will be cost of such education in similar institution in or near the locality minus amount recovered from the employee. However, there would be no perquisite if such cost of education, if the cost of such education or value of such benefit per child does not exceed ₹1,000 per month. It should be children of employee only and not any other member of household for whom such educational facilities are provided. And it will not be treated as a taxable perquisite if such benefit does not exceed ₹1,000 per month per child. In other circumstances, if the employee is able to avail the benefit of free or educational facilities for his children, the amount of expenditure incurred by the employer on behalf of employee minus amount recovered from the employee will be the value of. So the next perquisite, use of motor car. On motor car, running and maintenance expenses are incurred. There are 3 cases under the use of motor car. The first case is the motor car is owned or hired by the employer and expenses are also paid by the employer. Here, the motor car, when it is used only for personal use of the employee, then the amount attributable towards wear and tear, that is 10% per annum of actual cost or the hire charges, as the case may be, will be the value of perquisite. To that, we may add any expenses incurred by the employer, including the driver's salary, if it is also provided by the employer. From that amount, we will reduce any amount recovered from the employee. This will be the taxable perquisite if the motor car is owned or hired by the employer, expenses are also paid by the employer, and it is used wholly, it is used for the personal use, wholly for the personal use of the employee. If the employee uses the motor car for partly personal use and partly official use, then the taxable perquisite would be ₹1,800 per month if it is a small car, that is up to 1.6 cc, or ₹2,400 per month if it is a big car, that is greater than 1.6 cc. This will be the perquisite, to which we will add ₹900 per month if a driver is also provided for such motor car by the employer. There is no deduction for amount recovered from the employee because the car is being used partly for personal use and partly for official use. So the taxable perquisite will be rupees 1800 or rupees 2400 per month based on the car plus 900 per month if the driver is provided. That will be the taxable perquisite value. If the car is owned by the employer but expenses are paid by the employee, then we will just take the amount which is attributable towards wear and tear, that is 10% per annum of actual cost or the hire charges, as the case may be. To this we will add driver's salary if it is provided by the employer. From this we will deduct amount recovered from the employee. Then for partly personal and partly official use, in such case rupees 600 for small cars and or rupees 900 per month for big cars will be the taxable value of perquisite, to which we will add rupees 900 per month if driver is also provided by the employer for such car. No deduction for amount recovered from the employee will be provided. The next case is employee owns the car or hires the car, for which employer incurs the expenses. If it is used wholly for personal use of employee, the expenses incurred by the employer minus amount recovered from the employee will be the taxable perquisite. But if the car is used partly for personal use and partly for official use, then the expenses incurred by the employer minus rupees 1800 per month or rupees 2400 per month based on the car minus amount recovered from the employee will be the taxable perquisite. The next case, when the employee owns the car and he himself bears the expenses, there is no perquisite. If other than motor car, any other automotive conveyance is provided by the employer, it is owned by the employee and expenses are incurred by the employer, then actual expenses incurred will be the taxable perquisite if it is wholly used for personal use of employee. If such other automotive conveyance is used by the employee partly for personal use and partly for official use, the actual expenditure incurred by the employer minus rupees 900 per month will be the taxable value of perquisite. Remember one point, guys, if the motor car is wholly used for official purpose, then there is no perquisite if employee maintains specified documents. And also, for partly official and partly personal use, if employee claims that he has incurred more expenses for official purpose than the limits, employee claims that he has incurred more expenses for official purposes than the limits provided, then the actual expenditure incurred can be deducted if the employee has maintained specified documents, like the employer has maintained complete details of the journey undertaken for the official purpose, including the date of journey, destination, mileage and amount of expenditure incurred thereon. And also the employer certifies that the expenditure was incurred wholly and exclusively for the performance of official duties, then the actual expenditure incurred can be deducted. Where more than one motor car is provided by the provided to the employee, one motor car is considered to be provided for partly official and partly personal purposes. The other motor cars shall be deemed to be provided only for personal purpose. So we have to take only one motor car is provided for partly official and partly personal purpose. The other motor cars shall be considered as being provided only for personal purpose of the employee. Now let us discuss the next component of computation of salary income, that is retirement benefits. The first retirement benefit is gratuity. If gratuity is received during the job, it is fully taxable. But gratuity, if it is received during the retirement of employee, at the time of retirement of the employee, for government employees it is fully exempt. But for non-government employee, there are two cases. The first case is the employee is covered under Payment of Gratuity Act. In such a case, we will add the gratuity amount received in the computation of salary, and then we will provide for exemption. The exempt amount shall be least of these three: the actual amount received, or the statutory limit of rupees 20 lakh, or 15 by 26 into last round salary into number of completed years or part in excess of 6 months. That means if employee has served for 6 months or more in any year, that will be considered as 1 year. Salary for this purpose will be basic salary plus dearness allowance last drawn, if the employee is not covered under Payment of Gratuity Act. The least of the three shall be exempt: actual amount received or statutory limit of rupees 20 lakh, or 1 by 2 into average salary of the last 10 months into number of completed years of service. Ignore any fractions. Only if the employee has served for 1 year, it will be taken as 1 year. If he has served for any number of months than 12 months, less than 12 months, it will be ignored. Salary for this purpose will be basic salary plus dearness allowance forming part of retirement benefits plus commission on turnover basis, which is average of last 10 months. The second retirement benefit is pension. Uncommuted pension is fully taxable for all employees. Commuted pension, that is pension received in lump sum, will be fully exempt in case of government employees. For other employees other than government employees, there are two cases. The first is when employee is in receipt of gratuity. If he receives gratuity too, then the exempt amount will be 1/3 into commuted pension received divided by commutation percentage into 100. If the employee is not in receipt of gratuity, then 1 by 2 into commuted pension received divided by commutation percentage into 100 will be the amount of exemption. First we will add the pension amount. From that we will deduct this exempted amount. Supreme Court and High Court judges will be exempted of the commuted portion. Pension income is exempt if assessee is central government or state government employee and has been awarded Paramveer Chakra or Mahavir Chakra or Veer Chakra or such other gallantry awards. In case of death of such individual, any income by way of family pension received by any member of the family of such individual shall also be exempt. Remember these three important points regarding the pension. The third retirement benefit is leave encashment. Leave encashment received during the job is fully taxable. Leave encashment received at the time of retirement, for government employees it will be fully exempt. But in case of other employees other than government employees, the least of the following shall be exempt. The least of these 4 points. The first one is actual amount received. The second is rupees 3 lakh or cash equivalent of leave standing at the credit of employee, that is remaining leaves. Leaves allowed minus leaves taken is the remaining leaves for the employee into average salary per month divided by 30 days. The fourth point is 10 months salary based on average salary of last 10 months preceding retirement. The least of these 4 points will be the exempt amount in case of leave encashment. Salary for computation of leave encashment will be basic salary plus DA forming part of retirement benefits plus commission on turnover basis, which is average of last 10 months preceding the date of retirement. The retrenchment compensation. For retrenchment compensation, the exempt amount will be least of compensation actually received or rupees 5 lakh or 15 by 26 days salary into completed years of service and part thereof in excess of 6 months. Salary includes all components, but bonus and employee's contribution towards PF should not be included while computing retrenchment compensation. While computing exemption under retrenchment compensation. Average salary for preceding 3 months preceding the date of retirement should be taken. Voluntary retirement compensation. For this, the exempt amount will be list of compensation received actually or rupees 5 lakh or 3 months salary into completed years of service, or last drawn salary into remaining months of service left. Employee of central government or state government, public sector company, any other company, local authority, cooperative society, IIT are eligible for exemption under voluntary retirement compensation. So these are the retirement benefits. The next topic is Provident Fund. There are 4 types of Provident Funds: recognized, unrecognized, statutory and public Provident Fund. There are 5 aspects we have to remember regarding these Provident Funds, that is employer contribution, employee contribution, interest credited on employer contribution or employee contribution, and amount withdrawn on retirement or termination. First, let us discuss recognized Provident Fund. If employer contribution exceeds 12% of salary of employee, such excess amount will be taxable. And coming to employee's contribution towards the recognized Provident Fund, it is eligible for deduction under section 80C under the optional tax regime. That means it is taxable under default tax regime. Interest credited on employer's contribution. If the amount is in excess of 9.5% per annum, it is taxable. If the interest is in excess of 9.5% per annum, it is taxable. If it is less than 9.5%, it will be exempt. Interest credited on employee's contribution, amount in excess of 9.5% per annum is taxable. Amount withdrawn on retirement or termination. Any amount withdrawn on retirement or termination from the recognized Provident Fund will be exempt subject to the given below conditions. That is, it will be exempt if the employee has served for a continuous period of 5 years or more under the employer and he retires before rendering 5 years of service. If the employee retires before rendering 5 years of service, the reason should be because of ill health, any contraction of disease or discontinuance of employer's business, or reason beyond the control of the employee. Either on cessation of employment, the employee obtains new employment at some other place, and to the extent the accumulated balance in RPF is transferred to his RPF account maintained by the new employer. The entire balance standing to the credit of employee is transferred to his NPS account, referred to in section 80 CCD and notified by the central government. If these conditions are met, then the exemption will be allowed to the employer, to the employee if he withdraws amount on his retirement or termination from the recognized Provident Fund. Next is unrecognized Provident Fund. If employer contributes towards unrecognized Provident Fund, it is not taxable at the time of contribution. But employee's contribution is not eligible for any deduction. It will be taxable. The interest credited on employer's contribution is not taxable at the time of credit of interest. The interest credited on employee's contribution is also not taxable at the time of credit of interest. The amount withdrawn on retirement or termination from unrecognized Provident Fund, if the amount is attributable to the portion of employer's contribution and interest thereon, it is taxable under the head salary. If the portion of amount which is attributable towards the employee's contribution is not taxable, but the interest which is earned on the employee's contribution towards the unrecognized Provident Fund will be taxable under the head other sources. So at the time of withdrawing the amount on retirement of termination, the portion of employer's contribution and interest thereon will be taxable under the head salary. The portion of employee's contribution is not taxable, but the interest on employee's contribution will be taxable under the head other sources at the time of retirement or termination in case of unrecognized provident fund. Coming to the statutory provident fund. It is fully exempt when employer contributes for statutory provident fund, and also employee's contribution will be eligible for deduction under section 80C if assessee pays tax under the optional tax regime. The interest credited on employer's contribution will be fully exempt, and interest credited on employee's contribution will be exempt up to certain limit of contribution. Regarding that limit, there is one note here. The exemption would not be available for interest accrued during the previous year to the extent it relates to the amount or the aggregate of amounts of contribution made by that person or employee exceeding rupees 2,50,000 in any previous year in that fund on or after 1st April 2021. The limit would be extended to rupees 5 lakh where there is no employer contribution. Interest accrued up to such limits would be exempt. That means employee's contribution is exceeding rupees 2,50,000. Then any interest accrued on such excess amount exceeding 2,50,000 will not be exempted. Up to 2,50,000 it is exempt, but above 2,50,000 when the contribution is made and interest is earned on such excess amount, such interest amount will not be exempted. If there is no employer contribution, then the limit will be not 2,50,000 but 5 lakh rupees. Amount withdrawn on retirement or termination from the statutory provident fund will be fully exempt. Then comes the public provident fund. There will be no employer contribution towards the public provident fund. Only employee's contribution will be there, and it will be eligible for deduction under section 80C under optional tax regime. So since there is no employer contribution, there will be no interest on employer's contribution, but interest on employee's contribution is fully exempt in case of public provident fund, and at the time of retirement or termination, if he withdraws any amount from public provident fund, it will be fully exempt. Now let us discuss deductions from gross salary. Section 16 deductions. The standard deduction in both the regimes is up to rupees 50,000. The first deduction is standard deduction, which is up to rupees 50,000 under both tax regimes. Then the second deduction is entertainment allowance. This deduction is provided only under optional tax regime. It is allowable only for government employees under optional tax regime, and least of the following is allowed as deduction: rupees 5,000 or 1/5 of basic salary or actual allowance received. Out of these three, the lowest amount will be allowed as deduction for entertainment allowance only for government employees, and that too under optional tax regime. The third deduction is professional tax. Even for professional tax, deduction is allowed only under the optional tax regime. Any sum paid by the assessee on account of tax on employment is professional tax, and in case of professional tax is paid by the employer on behalf of the employee, the amount paid shall be included in gross salary as a perquisite, and then deduction can be claimed. Remember, there is one point in taxable perquisites for all employees. In that, any obligation which can be paid by the employee, but it is paid by the employer, it is met by the employer, it will be a taxable perquisite in the hands of employee. So we have to first add such amount which is paid by the employer, and from such amount deduction can be claimed. The next topic is relief when salary is paid in arrears or in advance. There might be cases where salary is paid in arrears or salary is paid in advance, and our Annual Finance Act and the tax rates, the tax regime may be changed from time to time. Due to the changes, sometimes the assessee may benefit or sometimes he may incur any loss. So there will be relief provided when the salary is paid in arrears or in advance. To such amount, the salary which has been paid in arrear or advance. To such portion, a relief is provided under section 89. How it is calculated? Simply, first we calculate the tax payable of the previous year in which the arrears or advance salary is received by considering the total income inclusive of the additional salary. In previous year in which such additional salary, either paid in advance or paid in arrears, is received, we have to include that amount, and as by considering it as total income inclusive of additional salary, we have to calculate the tax payable. Then we will calculate the tax payable of previous year in which the arrears or advances received by considering total income exclusive of such additional salary. We will exclude such arrears paid or advance paid. Now we will compute the difference between step 1 and step 2. 1 minus 2. Inclusive of the additional salary minus exclusive of the additional salary. The tax payable inclusive of arrears or advance minus tax payable by excluding arrears or advance. That is the third step. Calculate the tax payable of every previous year to which the additional salary relates to on total income, including salary of that particular previous year. Now we will include this additional salary to the previous year to which it is related to. Calculate the tax payable of every previous year to which the additional salary relates to on total income, excluding the additional salary of the PY. Now we will calculate this tax payable by excluding such additional salary which relates to the tax payable of every previous year to which the additional salary relates to on the total income by excluding the additional salary portion, by computing the difference between step 4 and step 5. That is, inclusive of the additional salary minus excluding the additional salary. The relief will be the amount arrived at step 3 minus amount arrived at in step 6. Such amount will be the relief under section 89. Similar tax relief is extended to assessees who receive arrears of family pension, and no relief is provided at the time of voluntary retirement or termination of service. With this, we have discussed all the components which are attributable in computation of income under the head salaries. Now, in the beginning, we have discussed how is salary computed under the optional tax regime. In that, if you can see, I have highlighted few points in purple color. These points represent those allowances which are not allowed under the default tax regime. That means here the house rent allowance under the optional tax regime is partly exempt. From the house rent allowance amount, we will deduct some exempt amount. But in case of default tax regime, house rent allowance is fully taxable. Same with children education allowance and children hostel allowance. In optional tax regime, we are children education allowance is exempt up to ₹100 per month per child up to maximum of 2 children. For children hostel allowance, the amount will be up to ₹300 per month per child up to maximum of up to maximum of 2 children. This exemption is not provided under default tax regime. So children education allowance and children hostel allowance will be fully taxable under default tax regime. Coming to the leave travel concession. Leave travel concession is also fully taxable under the default tax regime. And entertainment allowance, professional tax or tax on employment. These two are deductions which will not be provided under the default tax regime. The only deduction assessee can claim under default tax regime will be standard deduction on amount of salary. That is the amount of salary or ₹50,000, whichever is less. This will be the standard deduction. With this, we have completed the revision of income from the income under the head salaries. I hope this video is helpful for you guys, and also I hope this video has helped you clear few doubts. We will be uploading the next chapters in further videos. Thank you for watching the video.